Investing Strategy Episode 2: Why you should open a spread betting account even if you don't want to. This video is for a specific set of people. If you live in the UK and if you're new to investing or not a buy and hold investor, then this can help you. For others, it can still be helpful to know. Reason 1: tax. The primary reason for using a spread betting account is profits are tax-free. Yes, tax-free. The HMRC is not dumb and it's in their advantage to do this. How so? Well, I've seen stats that 70% of investors lose money on spread betting. The government doesn't tax gambling profits because gambling results in losses more than it does profits. This means if you make losses, the government has to give tax rebates. And since most lose on gambling, the government don't want to do this. Don't worry, I'm not suggesting you change any behavior or start gambling. We are just going to use the tool of not having to pay tax. The exception is if you spread bet as your main income, then obviously you are making profits and the government wants to tax you. Reason 2: scale. I'm not talking about scaling up, I'm talking about scaling down. Spread betting is different than share trading. You don't pay a fixed fee per transaction. You pay a spread. That's a percentage of the cost of the transaction. That means you can bet one share or less than one share easily. For instance, part of a Berkshire Hathaway share, although Berkshire Hathaway is another story. As there's no fixed transaction fee, if you're starting out or testing strategies, then spread betting is going to save you money. Here's a tip: if you're starting out investing by stock picking, chances are you're probably going to lose. You're up against wisdom, experience, firms and individuals doing this for a living, very smart people, your own discipline, your own weaknesses. Other market participants are probably going to eat you for lunch. Make sure you have a winning strategy that works before you scale up. I understand the logic that if you're identifying winning shares and only have a small scale, then you may regret it. But if you're so good at identifying shares, then you get plenty more opportunities when you do scale up. But as a newbie, that's not likely. If you're identifying losing shares you think are winners, and then they're not, that's going to be more regrettable. Reason 3: leverage. For a spread bet, you don't have to put all of the cost of the bet down, only a proportion. If the bet goes your way, then that's great. If not, the broker will ask for more money, a margin. Remember that the first table said that 70% of spread bettors are losers? I figure that's because they don't use leverage in the right way, and when they get it wrong, they get cleaned out. Although you only have to put a percentage down, treat the purchase as a share and always keep the cash needed that has not been paid up front in the call account. You can earn interest on the funds in the call account, but have it ready. Reason 4: short selling. Short selling is betting against a share. This is not something I do, even when right about companies like House of Fraser or Debenhams. Even if you know the company is going bust, some lunatic can make a random offer for the company. It's too risky. Your downside is unlimited. So, there are some downsides of spread betting. A spread bet is a bet, so it has an endpoint. Each time you take a bet, there is a spread. The best you can do in this instance is take the longest duration bet there is, so your bets don't keep rolling over and charging you frequent fees. Another downside is you don't own the share at the end. But if you're a short-term to medium-term investor, that's not a problem. You only want to make money on the movement. Given you're probably a stock picker, then the chances are you won't be a long-term investor. A stock picker should review their picks frequently. The final downside is some employers will not let you have a spread betting account. They don't want you getting in trouble and in debt and beholden to someone else. The author will not be held liable for any errors or ideas contained within. The video is only intended to educate and not to be taken as investment advice. Please do your own research or consult your own financial advisor. I hope you found this useful. If you have any questions or comments, I will try and answer them. Please subscribe to keep up with the lectures.